This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or trading will guarantee profits or not result in losses from trading.
Good Friday afternoon, traders. I'm Scott Norris, wrapping up the week. Today is January 12th, 2007. The dollar experienced very mixed results in the majors this week as it struggles to post big gains against high interest rate bearing currencies. The yen was this week's obvious loser, falling against all of the major currencies. Despite a consensus estimate from economists for a BOJ rate hike next week, traders do not seem to be buying into such speculation. Central bank activity this week included ECB and BOE meetings early yesterday morning. The Bank of England was up first and unexpectedly hiked rates by 25 basis points. The initial reaction of the pound sterling was a big jump, followed by an unexpected plunge. However, more than 24 hours later, we can see the move has ultimately helped the currency in a big way. The European Central Bank not only held rates steady as expected, but watered down the hawkish tone in the accompanying press conference by removing the term vigilant from its prepared text. The omission did not slip by traders, and the euro has suffered since. U.S. data this week was very limited, with the big headliner coming out this morning. December retail sales posted larger than expected increases in both headline and core readings, while November figures were revised lower. While collectively the results should still be a dollar positive, the currency has seen one of its worst days this week. Another big factor this week was the price of crude oil, which fell 6% over the last 5 days. We today saw a 19-month low of $51.75 a barrel, which is very good news for the greenback. We should expect that a continuation below $50 a barrel will allow the buck to remain buoyant, even through disappointing economic releases should any arise. Conversely, the price of oil is one of the few fundamental reasons we can identify for a run in the dollar, which means a significant rebound in crude could turn things around quickly. Now to the big picture. We discussed the recent slide in oil last week as it fell below $60 a barrel and the implications it would have on FOREX. We saw oil fall another 6% this week, which prompted an additional round of dollar buying. The question is how much further oil prices will fall before it finds a bottom. OPEC will likely take further action on production limitations if we see sub-50 levels, which may hold traders back from shorting at current prices. This leads us to believe that dollar bulls are going to have to find new reasons to hold or buy dollars in the form of economic data. If in fact U.S. data continues to point toward a soft landing, the greenback may have more room to run. However, data that indicates the contrary could pull the rug out from under its feet. The technical picture shows us an overbought dollar against currencies such as the euro and franc, while a few other currencies never gave up enough ground to allow this. The group of currencies known as the majors is now as divided as ever. However, such a phenomenon rarely lasts very long. This means that while currencies such as the pound, Aussie, and Kiwi may show resilience in the event euro-dollar continues to fall, we do not see these pairs moving in opposite directions on a daily basis. By the same token, big rallies in higher interest rate bearing currencies will cripple any rally attempts by the dollar against currencies such as the euro, franc, and possibly even the yen. Expect the battle of these opposing forces to keep the market volatile next week and keep a close eye on the price of oil. Till then, have a wonderful weekend. Take care.